Okay, good afternoon, everyone. Today we're going to be talking about debit versus credit spreads. My name is Tony Zhang. I am the chief strategist here at Options Play, and today we'll be talking about these two strategies, and I think it's a pretty good topic considering how choppy the markets have been. It's really important to understand the difference between these two spreads. And the reason for that is because I want to dispel some myths, first of all, about these two spreads, how they should be used. When I talk to some users, sometimes I find that this strategy is misused depending on the market conditions. So I want to take some time out today and basically explain to everyone what is the fundamental difference between debit versus credit spreads so that you can use them appropriately when you're in your trading. So before I get started, I'm just going to put out a quick poll here. I'm just going to get an idea as far as the level of options traders I have here in this webinar. So please answer the question that you see on your screen. I just want to get an idea as far as, have you traded options before, if you're brand new or if you've been trading options for a while, just so I get a feel for who's in the room. Okay, looks like a very, very large percentage of you have been trading for a while, about 85, 90% of you guys. Just about 10 to 12% of you guys are brand new to options trading. Okay, great. This is good because this webinar does require a little bit of understanding of options, but if you're brand new, it's okay. If you're brand new to options trading, welcome. I really hope that what we show you guys here today will help inspire you to start taking a look at options with your trading. Spreads is a great way to start with your options trading because it's a strategy that has limited risk, which is really always an important thing to do when you're starting out with options. When I talk to people who are starting out, they always say options are a little risky. I'm not sure how to do this. Spreads are a great way to help you get into options trading while still limiting your risk. So today's webinar, what I will do is I'm going to spend about 10 to 15 minutes using slides talking about the fundamental differences between debit and credit spreads. I want to make sure everyone understands, what the trade-offs are between each two strategies and what type of market conditions you should use each strategy in. And then what I'll do is I'll spend the rest of the time showing you guys real examples using real stocks with options play so that you can actually put the two side by side and learn exactly when you should be using each strategy. I'll try to go through as many examples as I have time for today so that you guys have as many ideas in your head. I'll even use some of the recent trades that we've been placing on Tyson Foods as one of my examples to show you the difference between trading debit versus credit spreads. Now, since most of you have traded options before, then I'm going to put up a second poll here. I just want to get a feel for what type of spreads you guys currently trade. So do you guys prefer trading debit spreads or credit spreads? Just so I can get a feel for who's in the room as well. And this webinar is recorded, so we will be going through a lot of content today. I'll be talking in detail the differences between credit versus debit spreads. So I want to make sure that you guys understand the differences. So the recording will be sent out about an hour after we're done. So if you're brand new or if you need some time to review the stuff that we're talking about today, make sure you come back to look at the recording. I'll even include the slides so that you can follow along as you go through the recording, so that you can take not only so that you can have a better understanding of the difference between these two spreads, but also you can review the examples that we're going to go over here today. So it looks like actually more of you like to trade credit spreads versus debit spreads. So great. So I really want to make sure that we spend the time here today making sure that you guys all understand the difference between the two. One of the things that I have noticed as I talk to users is that there seems to be more people who like to trade credit spreads. And there's nothing wrong with credit spreads. It's just I want to make sure you guys understand when is the correct market conditions to do so. You shouldn't trade credit spreads all the time. So I want to make sure we all understand the difference between the two so that we're applying it correctly depending on the market conditions. So here you go here. It looks like more of you like to trade credit spreads than debit spreads. So let's just go ahead and get started here. Today, what we're going to talk about, number one, is what are vertical spreads. This is really for those of you that are brand new to these types of trades. I'll go over a little bit about how to structure them, what they are, what type of spreads are available. More importantly, what I really want to do is spend the time talking about when to use them. So once we get through the fundamentals between the difference, we'll help you identify what type of market conditions are suitable for trading each type of spread. And then lastly, and most importantly, how do you trade them effectively? Meaning, how do you make sure that you're entering the trades properly? How do you make sure you manage the trades once you're in them properly, and making sure you exit the trades when you need to? We'll talk about the different rules for doing that. And lastly, like I said, what we want to do is actually show you examples of them using options play, so that after you finish this webinar, you actually are confident enough to use our platform and start structuring these types of trades for yourself, comparing them and making sure that you trade the correct strategies. So just to start off, what are vertical spreads? Vertical spreads are strategies or option strategies, multi-leg option strategies that have predefined risk and reward, meaning you know exactly what your potential reward on the trade is and what your potential risks are before you place a trade. Now, we've broken down these into bullish and bearish and credit versus debit. And today we're really going to be talking about the difference between the debit side versus the credit side. So on the debit side, if you're bullish on a stock, you would trade a bull call vertical. If you're bearish on a stock or ETF, you would trade a bear put vertical. On the credit side, if you're bullish, you would trade a bull put vertical. So the difference between call versus put here. You would trade the bull put vertical, and if you're bearish, you would trade the bear call vertical. So let's talk a little bit about what are the differences between these, okay? So like I said before, vertical spreads have predefined risk and reward, and that is a key distinction between this strategy and any other strategy when you're trading options, because most other trades, you do not necessarily have predefined risk or reward. You may have one or the other, but you may not have both. So this is really important that you will, to understand this strategy gives you both predefined risk and reward for all strategies before you get into the trade. And that's really why these are some of the favorite strategies for us to trade, because we want to make sure we know our risks and rewards before we place our trade so that we can plan accordingly. And for those of you that are beginners and you're concerned about risk, this strategy allows you to define your risk before you get into a trade. So when we're talking about debit spreads, we're really talking about bull call verticals and bear put verticals. Now, when we're talking about credit spreads, we're talking about bear calls verticals and bull put verticals. So let's break down kind of the difference between the two. So when we're doing a bull call vertical, and in this particular example, I'm using XYZ stock that's trading at $100. A bull call vertical is essentially where you're buying an at-the-money call or a $100 call, and you're selling a further or higher call. So you're selling a 110 call. That's how you structure a bull call vertical. So this is what you would do if you were bullish on this XYZ stock that's currently trading at $100. A bear put vertical is basically the opposite. You're basically buying an at-the-money put, a $100 put, and then what you're doing is you're selling a lower put against that, about a $90 put, for example. And you would structure this type of trade if you were bearish on this stock XYZ. And the difference here is that what you're doing is the entry is a debit to your account and the exit is a credit to your account, okay? And I'll come back to this in a little bit. When you're trading credit spreads, this is where we have a bear put call vertical, and this is in the same stock on stock XYZ. If you're bearish on the stock, you would sell an at-the-money call, and then you would buy back a further 110 call. Okay, so you can trade this as a credit strategy if you're bearish on the stock XYZ. And if you're bullish on the stock, you can trade a bull put vertical where you're selling the 100 put or the at-the-money put, and then you're buying back a lower put, like a 90 strike put. And you would do this if you're bullish on the stock. And when you're trading a credit spread, what you're doing is you're receiving a credit when you enter the trade, and then you have a debit when you exit the trade. So the difference between the debit versus credit really comes into whether you're debiting first and then crediting later, or crediting up front and then debiting later on the exit. And And from a trading perspective, it really doesn't matter whether you credit first and debit later or debit first and credit later. But I do find that when I talk to people, people tend to prefer getting a credit up front. And I'll be honest, I'm not really quite sure why, because at the end, the net is all the same, right? Whether you get debited $2 and then credit $4 to make a $2 profit, or you take the $4 credit up front and then debit the $2 later, you still get the $2 profit. It doesn't really matter which one you do first, but I tend to find that people tend to like getting a credit first. And I'll be honest, I really don't understand why if the net result at the end is the same. So that is one of the reasons why I tend to find more people gravitate towards credit spreads. And that's really part of why we're also doing this webinar, because we want to make sure that everyone understands the differences between debit and a credit, because it's not just the difference between getting a credit up front and getting a debit later. So let's talk a little bit about the difference. So the key difference between trading debit versus credit spreads is understanding the relationship between probability and risk reward, okay? All options trading is simply a trade-off between probability and risk to reward. It doesn't matter if you're buying calls or puts, selling calls or puts, trading debit versus credit spreads, or trading iron condors or more complex strategies. All options trading is a trade-off between probability and risk to reward. And it's important to understand why these two strategies differ from this important relationship. Okay, so when we're trading debit spreads generally speaking will have a low probability of profit or a lower probability of profit. So typically with a debit spread, you might see something where you might have a 40% probability of profit. So 40% of your trades might be winners and 60% of your trades might be losers. And I tend to find that especially a lot of beginners who are trading will say, why would I ever trade a strategy that has 40% winners and 60% losers? And the reason is because you have high risk to reward, meaning you are typically risking less money to make more money. So for example, you might be risking $50 to try to make a $100 gain, okay? So with that, and I'll talk a little bit about this in the next slide, how that affects your trading in the long run, but most people, or at least when I trade, I tend to focus on the fact that I want to risk less to try to potentially win more. Okay, and I will accept smaller or less losers, if you will, in order to take less risk. Credit spreads are kind of inverted, okay? Credit spreads have high probability of profit. So sometimes when you're trading credit spreads, you'll see 80% probability of profit. And this is really where I see a lot of beginners tend to gravitate towards credit spreads, because they're saying, oh, I want something with high probability of profit, but the trade-off here is you have very low risk to reward, meaning you're typically risking a lot more money than you can potentially make on the trade. So you might be risking somewhere like $150 to try to make $50. So that's the trade-off you have between probability and risk to reward. And it's really important to understand the two and what type of probability you're getting, what type of risk reward you're getting, and making sure you choose the strategy that best suits your trading, okay? And we'll talk a little bit about that in the next slide. But this is the most important concept of all options trading, is understanding this relationship, because you want to make sure that you find a balance between these two. You don't necessarily just want to chase really high probability, because it's going to come out of your risk reward, and vice versa. If you try to chase really high risk reward, you're going to get really, really low probabilities. You don't want one extreme or the other. You want to find a balance. So let's talk about kind of what each one of these looks like when you're actually trading. So like I said, when you're trading debit spreads, you're going to have less winners, but you're going to have bigger rewards. So here I have a set of trades, and I just have a sample of 5 trades that someone might make trading debit spreads and what it feels like to trade debit spreads. Basically, you are going to have less winners than losers. So here I have 3 losing trades where I'm losing $50 each, and then 2 winning trades where I'm winning $100 each. And as you can see, the net result here is I've made $50 after 5 trades. Okay, I'm going to take relatively similar stats for the credit spreads. Now, what I'm going to say, like I said before, you're going to have a lot more winners when you're trading credit spreads, but you're going to be making $50 each time. So 4 out of the 5 trades, you might make $50. And then 1 out of those 5 trades, you lose $150. So what that ends up happening is the net is still the same, roughly $50. So I want to make sure that everyone understands that the net result here may be very similar, but the path to how to get there is very, very different, okay? So when you're trading debit spreads, you have to expect more losers. However, when you win more money. Conversely, when you're trading credit spreads, you're going to be collecting a lot more winners, but the ones that you lose, you're going to lose substantially more. So as you can see, as I'm trading credit spreads, I'm making $50, $100, $150, and the next trade wipes out all of that. Okay, so that's type of trades that you might be making when you're trading credit spreads versus debit spreads. I'm making $100, losing $50 each on the next one, so I'm down back to 0. Then I'm making 100, down another 50. And it really ends up nearly the same result. However, there are 2 very different paths to how to get there. So it comes down to kind of a personal preference as to kind of which type of strategy you feel more comfortable doing. Do you feel comfortable getting more winners but losing more money when you lose? Or are you the type of person who's okay with having more losers, but every time you win, you're generally winning more? So this is the type of trade-off that you have between probability and risk reward. That's really important to understand before you go ahead and start trading each one of these strategies. So I want to talk a little bit about what type of market conditions you should be looking for when you're trading these. And we'll go through some real examples here. But when you're trading debit spreads, typically what you're doing is you only want to trade them when you're expecting a large or quick move in one direction or another. Okay, so basically this is typically used if you see a breakout or a rebound off of support and resistance levels and you're expecting the stock to basically make a very quick move, possibly a very large move in a relatively short amount of time. And these types of strategies are best used in lower volatility environments. So stock that has a relatively low volatility compared to historicals, these are typically better times to trade debit spreads. When you're trading credit spreads, it's a completely different strategy. Okay, so it's really important to understand that you can't just trade a credit spread because you shouldn't necessarily trade a credit spread if you expect a large move up or down, because your debit spread will be better for that. A credit spread is really more so if you expect a neutral or a modest move. So if you don't expect the stock to move a lot, you think it's actually going to stick to where it is or where it is right now or stick to a certain level, that's really a better way to trade credit spreads or better time to trade credit spreads. And you typically can time this with what we consider as overbought or oversold conditions. So if you feel the market has kind of taken a large rally higher and it's really overbought, you don't necessarily know that it's going to come back down, but you are pretty sure it's not going to continue going higher. That's a good time to trade a credit spread. Or if a stock's been taking a huge beating and it's been oversold, you don't necessarily think it's going to bounce back higher, but you do think it's not going to continue going any lower. These are the types of strategies where you might want to trade, a credit spread. And they are generally better used in higher volatility environments. Okay, so you don't have to memorize this. These slides are available to you after the webinar, and I know I'm covering a lot of things, so that's why I do encourage, for those of you that are taking the time to learn these types of strategies, to come back and watch the recording, but also follow along with the slides. So the key difference here that I think makes a big difference, at least to me, is the risk management between these two strategies, and they are a little different. And this is, generally speaking, why I prefer trading debit spreads, is because the risk management aspect of a debit spread generally is a little easier to do than a credit spread, but that's just my personal preference. And like I said, at the end result of the two, you may have very similar results in terms of profits and losses. However, like I said, it's a different path to get there. So let's talk a little bit about how to manage debit spreads when you're trading them. So we talked about the entry strategy, right? We talked about timing the entry with an expected large move. So this is really, again, when you expect the stock, if it breaks out of resistance and you think it's really going to move higher, or if it breaks support and you think it's really going to move lower, these are the types of times that you would want to trade a debit spread. Also, if you found that a stock has bounced off support or bounced off resistance, these are also good timing indicators to potentially get into a debit spread. Now, when it comes to exit strategies, this is really where the difference between debit and credit spreads really kind of differ. And personally, this is why I prefer trading the debit spread, because the exit strategy piece is usually a little easier to manage, a little easier to figure out, because it's the same regardless of what type of debit spread you trade. And really, the key to managing a debit spread is cutting your losses if the move doesn't materialize. What I mean by that is if you see a stock is breaking above resistance and you think it's going to continue moving higher, and you trade a debit spread on that premise, and the stock just doesn't really break any higher, it breaks that resistance and kind of just putzes around and just stays around that same level, that is basically telling you your initial analysis of this stock is going to break resistance and continue higher is wrong, then that is the signal to get out. So it's very easy to understand when to get in and when to get out of a debit spread, in my opinion. You generally exit these trades before expiration, either at a gain or a loss. That is the key difference one of the key differences between trading debit versus credit spreads is that when you're trading a debit spread, you want to exit the trade before expiration. You almost never want to hold the debit spread into expiration. And the rule of thumb here is cutting losses generally when you've lost about 50% on the trade. So if you pay $1 on the debit spread and it's trading at 50 cents or lower, it's time to cut your losses and move on. So it's a very simple risk management strategy. Conversely, on the upside, you want to take profits if you've gained anywhere from 75 to 100% of the premium you've paid on the debit spread. So again, also relatively straightforward way to calculate. So if you bought the spread for $1 and it's trading at $1.75 or $2, that's a time to start at least taking partial profits. If you're trading one contract, you should probably take full profits. If you're trading multiple contracts, like 5 or 10 contracts, you might want to at least take half that trade off at 75 to 100% gain, and leave the rest of the positions on if you think it's going to continue moving higher. In a lot of debit spreads, you can make 200, 250% returns on a debit spread. So a lot of times people do want to take partial profits and then keep some of their positions open so that they can continue to try to make that 200, 250% return, like we did on Philip Morris, which is a great trade that we made a couple of weeks ago. We're going to put out a recommendation to consider closing out that trade because it's now trading at about 230% gains on that debit spread that we put out a couple of weeks ago. So I'll go through that also as well as an example. So now talking about how to trade credit spreads effectively. Again, risk management is key when you're trading all types of spreads. Like I said, when we're talking about entries with credit spreads, you want to time them with what we consider tops or bottoms. So whenever you feel that a stock has topped, meaning you think it's not going to continue going any higher, that's a time to consider entering a credit spread. If you think the stock has bottomed and you don't think it's going to continue going any lower, that's another time to consider getting into a credit spread. And I will say one of the reasons that a lot of people like to trade credit spreads is you can string these call and put verticals together on a stock that you just follow very heavily. So some people just, follow a few stocks really, really well. They tend to have a good idea as far as how those stocks move. So every time they feel the stock has kind of reached the top, they'll sell a call credit spread. Every time they feel that the stock is bottom, they'll sell a put credit spread. And you can just continue to string this along, trade after trade on every single top or bottom. So this is really why this is one of the more popular trading strategies for people who like to follow specific stocks or ETFs. The exit strategy for credit spreads is quite different from debit spreads, and this is really why it's key to understand the difference. So when you're trading credit spreads, most of the time these trades will simply expire worthless. So you're collecting a credit, and the whole point is you want that credit, you want the trade to expire worthless so that you keep all of that credit and you don't have to pay anything or pay any debits to buy back or exit that trade. That is the point of the trade. So most of your trades should expire worthless, especially if you're trading credit spreads that have 60, 70, 80% probability of profit. Then most of your trades trades should expire worthless. However, when 20%, 30% of the time when the trades doesn't expire worthless and the stock trades through your strike prices, this is really where it's really important to manage your risk properly. And this is where you can lose a lot of money if you don't manage it properly. And so when it comes to credit spreads, it's a little trickier. It's a little trickier to calculate when it's time to cut your losses. So we've talked about taking profits is really just letting your trade expire worthless. Cutting losses is a little different. Cutting losses on credit spreads is dependent on how much premium you're receiving with relation to the vertical width. What I mean by the vertical width is the distance between the two strikes. So when you're selling a credit spread, in the example I gave you before with stock XYZ, if you're selling a $100 call and you're buying back a 110 call, that's a $10 width. Okay, so you have to calculate how much premium am I getting in relation to that $10 width. If it's greater than 20%, so if you're receiving more than a $2 credit on a $10 wide credit spread, then you want to cut your losses roughly when you've lost about 75 to 100% of the credit that you've received. So if you've received $2 and the trade is now trading at $4 or $5, that's time to consider getting out of the trade. You're going to take a $2 loss on that trade. If the premium you receive is less than 20% of the vertical width, so if you receive less than $2 on that $10 credit spread, then you want to cut your losses somewhere between 1 to 200%. So if let's say you've only received a $1 credit on a $10 wide spread, then you want to give yourself a little bit more room because the stock may not have to move very much in order for you to lose 100 to 200% credit of the credit that you received. So if the spread starts trading at $2 or $3, that's usually a time to consider getting out. So I know this is a lot to take in, and this is not necessarily always easy or intuitive to figure out. And that's really why I generally tell people who are trading credit spreads, make sure that you have a better understanding of options trading or have some experience trading options before you jump into credit spreads, because they do take a little bit more to help to manage them. You have to make sure you understand how much credit you're receiving in relation to the width of the spread, because that helps you determine how to manage your risk. So we'll try to go through a few examples here so that you guys can see what I mean by this. So let's start taking a look at some real examples on options play. And this is really why I wanted to take some time and use the tools to show you guys the difference between the two, because it's one thing for me to sit here and show you slides and talk about these things. It's another thing to actually see it in action, because it'll make a lot more sense once you see them with the trades that we're going to show you. So the first one I'm going to use is Tyson Foods, and I'm doing this because this is one of the trades that we highlighted yesterday. This was a trade that, at the time, it's a consumer staple stock, which is a relatively weak sector. This is a stock that's been in a fairly bearish trend for quite some time, and one of the things I noticed is that 72, 73 was a support level. As you can see, it was support here back in February, support back here in early March, support here around late March, and finally it broke that support level. And it finally came back up to test that 72 resistance level, that support level as resistance, and kind of bounced back lower. Same thing happened, came back up to 72, bounced back lower. So this was really a trade that we felt that, this was a rebound. We thought this was a test of resistance, and we think that it might continue going lower. So this is really why we chose to use a debit spread in this particular case, because we think that, number one, the stock has earnings coming up in a couple of weeks. We think that this stock can move down to 68 or even 67 easily in the matter of a couple of weeks. And that's why we chose to use a debit spread. But what I really want to do is show you guys the comparison between trading a debit versus a credit spread, because you can also use a credit spread. You can say that the 73 is a resistance level. It's kind of overbought. You don't think it's going to go above 73, but you don't necessarily know that it's going to move that much further down. So let's take a look at putting a credit spread next to a debit spread and seeing how they perform. So if the trade that we were looking at yesterday, I think was a 72.65 put vertical. And what I'm going to do is I'm going to put next to that a short call vertical, so a credit spread. And what I'm going to do here is I'm going to sell, let's say, a 72, and I'm going to buy back, let's say, a 74. So these are two very different trades, and for those of you that are brand new to our platform, welcome. You can set up all of the trades that you want by clicking on Modify, and we have a strategy constructor here that allows you to enter any strategies that you would like. So what I've done here is I've taken a debit spread next to a credit spread, and maybe we can even just buy a put here next to that, just for argument's sake, so that we can take a look at, you know, what it feels like to buy a debit spread versus a credit spread versus just buying an outright put on a stock. So let's take a look at buying this 72 put. Okay, and we'll use the midpoint for all of these just so we have a fair comparison. So before I look at each individual trade and compare the three, what I do want to do is normalize this based on how much money you might want to risk. So let's take a look at using the risk and investment calculator, and let's say I want to risk $2,000 on this trade. So now what I want to do is I want to take a look at how each one of these strategies perform. So if I'm willing to risk $2,000, as you can see here, this allows me to buy 5 put contracts. It allows me to sell 16 of these credit spreads, and allows me to buy 7 of these debit spreads. And as you can see, my max risk is roughly the same here. If I'm risking that amount of money, I can actually sell 16 contracts risking $2,000 on the credit spread. I can risk $1,800 on the debit spread, and I can risk $1,700 on the puts. Now, notice that when I'm trading the credit spreads, I'm risking $2,000, but my max profit or max reward is only $1,200. So this is where I'm talking about. You have a 66% probability of profit, so a higher probability of profit, but you're risking more money to try to make less money. Conversely, on the debit spread, I only have a 45% probability of profit, but I'm risking $1,800 to try to make $3,000. And that is the distinct difference between trading a credit spread versus a debit spread. So let's use our P&L simulator and actually see how these strategies will perform. So one of the things I talked about is I feel that the market is going to move a little lower on this particular trade because it's a weak stock and a weak sector. And I do think that the markets look a little shaky. It's on shakier ground today. So let's say I think this thing is going to move down to $67. And we know that there's actually earnings here on May 7th. So let's actually say what happens if a few days after earnings, let's say a week after earnings on the 14th of May, and we know that if you've watched any of our videos from the last few weeks, you'll see that the after earnings, the volatility will actually come down. So let's just also model that as well. And really, you could put whatever scenario you have in your views in this P&L simulator, and we'll show you exactly which strategy will give you the higher return. So here, if the stock moves down to $67 a couple of weeks after earnings or a week after earnings and volatility comes down, here's my expected return of each one of these strategies. So the credit spread actually gives me the higher percentage return on this particular trade. So risking the same dollar amount, roughly the same dollar amount, the credit spread will give me the highest return, 91% return versus 73% return versus only 48% return for buying the put. So here, if the stock moves down modestly lower, so like I said, this is a credit spread is for someone if you expect a modest move. So if you're not expecting a large move, the credit spread sometimes is the best trade to make. But if you expect a larger move, so let's say you think Tyson's going to really miss on earnings, it's going to go down to 65 or lower, that's when the debit spread starts to shine. That's when you're going to make a 98% return on the credit versus 118 or 119% return on the debit spread. So this is really where you can start comparing the two and side by side and see which one's actually best suited for you based on your outlook on the stock or ETF. So this is not a recommendation to go short Tyson per se. This is really just for illustrative purposes so that we can show you the difference between these two strategies. And you can also say, what happens if I think the stock's going to stay exactly where it is? So if the stock stays exactly where it is a few days after earnings, as you can see on the credit spread, you make a 43% return. On the debit spread, you lose 16% return. Okay, so you can use our P&L simulator, put in whatever scenario you think the stock's going to go to by expiration or anywhere, for any volatility expectation and see exactly when each strategy will actually start to outperform. So here I can actually tell you that if the stock goes to around 66.5, this debit spread will actually outperform the credit spread. So you can kind of ask yourself, do I think Tyson Foods is going to go to 66.5 or lower? If I do, then you should probably trade the credit spread. If you don't, if you do, you should trade the debit spread. If you don't, you should probably consider trading the credit spread. And that's really the power of this tool, is that it allows you to put any two strategies side by side, or any three strategies side by side, use the P&L simulator, and it will tell you exactly which strategy gives you the highest return. So, sometimes I get questions from people who, get our daily plays in the morning. They see that we're bearish on Tyson Foods. But you may not agree with our time frame, or you may want to trade a credit spread instead of the debit spread that we're showing you. That's really why we created this platform. Our daily plays are simply just ideas. So if we're saying, hey, one of our ideas is that we're bearish on Tyson, here's one trade that you can make if you're bearish on Tyson as well. But nothing stops you from coming in here, selecting bearish on the strategy constructor, and setting up any other trade that you would like. For example, a short call vertical to trade a credit spread, or a collar or a synthetic stock, or any other bearish strategy. That's really why we designed this tool. We're not saying that our strategy is the only way to trade our views. You can come in here, set up your own strategy, and put the two side by side. And if you feel that you have a better strategy, you can go ahead and trade it. That's really the power of our platform. And I really hope that kind of shines through today as I walk you through a few more examples here. Let's take a look at Facebook. Again, this is not any recommendations to trade Facebook. We don't necessarily have a view on Facebook. This is I'm just using this as illustrative purposes because this is a stock that I'm guessing many of you guys are following. It is a stock that currently is quite overbought. After it had its huge sell-off from 185 down to 150 and then rally back up. So the stock is kind of a bit overbought right now. So, this is typically the type of conditions that you would want to potentially sell a credit spread. So let's take a look at selling a credit spread on Facebook versus buying a debit spread. So what I have here is we can set up a bearish. We'll do a short call vertical, which is the credit spread. And it's trading at 168 right now. So maybe you might want to sell a 170 and buy back the 175s. Or maybe sell a 172 and buy back the 177s and a halves. You can choose all the different strikes that you would like. But usually you would sell something that's slightly out of the money and buy back something that's a little further out of the money. And so let's compare buying this or selling this credit spread versus buying this debit spread. And let's go to our calculator again. Let's say we want to risk $2,000. And let's take a look at each trade. So before I look at the trades, let's break down the trade, right? So here, again, I'm risking about $1,800 on the credit spread to try to make roughly $1,100. And I have a 65% probability of profit, so relatively higher probability of profit, but I have an inverted risk-reward ratio. You're risking more to try to make a little less money. On the debit spread, here I have a lower probability of profit, 42%. So I have a smaller chance of making money on this trade, but I'm only risking $1,900 to try to potentially make $4,000. And this is personally why I prefer trading them, because I like to risk less money to try to make more. But that's just a personal preference. As long as you understand the difference and understand how to utilize them correctly, there's no right or wrong. It's just sometimes it just comes down to a personal preference. So here, this stock is 170 level was a support level here back in early February. It was another support back here in early March, and then finally broke below that support when it kind of had all that trouble with Congress, and it's went all the way down to 150 and then bounced back higher, right back up to this 170 resistance level. And as you can see on this CCI, it looks like it's a bit overbought here. So these are the typical conditions that you would look at to sell a credit spread, because you think the stock is overbought. And especially considering it's trading just around a resistance level, you think that it's not going to continue going any higher. This would be an ideal condition to potentially sell a credit spread. So I want to put the two side by side, selling a credit spread versus buying a debit spread. So the debit spread would be a bit, if you're a bit more opportunistic, meaning you actually think that 170 is going to be an absolute high and you think it's going to come crashing back down to the 150 level, which is very possible on this stock. That this thing could come back crashing down to 150. It was just there a couple of weeks ago. It's not that crazy of a proposition. So let's take a look at the P&L simulator. So let's say what happens if the stock just stays around 170. It doesn't really go anywhere. So if it does that, as you can see, the credit spread clearly is the king here. You're going to make 100% return. You're going to make that $1,100. You're going to, which is the credit that you're receiving. You're going to keep all of that if the stock stays exactly where it is on expiration, versus if you had bought this put or put vertical, you actually lose 70% of your trade. You lose $1,300. So you would not trade a put vertical if you think the stock's just going to stay where it is. Conversely, if you think the stock's going to move lower, so if you think it's going to go down to, let's say, 155, here, as you can see, I'm still only going to make that $1,100 profit on the credit spread, because that's the most amount of money I can make, the credit that I receive. However, when I'm trading the debit spread, I'm going to make substantially more. Even though I'm risking the same amount of money, I'm going to make substantially more money, almost triple the profit that I do on the credit spread if I had traded the debit spread. So if I feel that Facebook is going to move lower, and it has earnings coming up in just a few days, so that could be a catalyst potentially for a move lower. If you feel that this thing, it might miss on earnings, and you think that the trouble that Facebook is having is going to be more longer term, then the debit spread may be a better trade for you to make, because you're going to have a substantially larger profit return on trading the debit spread versus the credit spread. And if the stock moves lower, as you can see, you'll continue to make more and more money on this debit spread versus that credit spread. Your credit spread, you're limited to that $1,100 that you've made. And conversely, if the stock takes off, let's say it beats earnings and the stock goes back up to 187, here you're risking, again, the same amount of money. So like I said, roughly that $2,000 level. The only difference here is how much money can you make if the stock moves lower. So this is the key difference between trading debit versus credit spreads, is understanding what your expectation of the stock is. If you're expecting a modest or neutral move, trade the credit spread. If you're expecting a larger move, trade the debit spread. But the key difference to understand between these two is the trade-off between risk to reward and probability. Once you understand that, you should be able to know exactly when is the appropriate time to trade each strategy. Don't just trade credit spreads because you like to take a credit. Because if you expect a large move to happen, trade the debit spread. You're going to get substantially more return on your money than you would with trading a credit spread. I know a lot of people like trading credit spreads because it feels nice to get a credit up front, but keep in mind that you just debit that later at the end, so it doesn't really matter which way you go, which one's first, which one's comes second. So I hope you guys have found this useful. And at this point, what I'll do is I'll open this up for Q&A. Please, if you have any questions regarding anything I just spoke about here today, please type them into the chat window. And I know there's quite a few Q&A questions already in there, so I'll try to answer as many of them as possible. I have a question saying, do we have to buy an at the money? No, you don't have to buy an at the money. You could buy a near the money if you're talking about a debit spread. But debit spreads, typically you should buy a strike that's near the money. It doesn't have to be absolutely at the money. It just has to be near the money. And then you want to sell something that's further out. Another question is, are you holding all trades to expiration? So no, I talked a little bit about the difference between debit versus credit spreads. So credit spreads, most of them, you will actually hold them to expiration when you're trading a credit spread. When you're trading a debit spread, you almost always exit the trade before expiration, either at a gain or a loss. So that's generally the difference between trading debit versus credit. I have another question saying, what happens if you hold the debit spread at expiration. Nothing really happens. It really depends on your broker and where you are in between that spread. So whether you get assigned on a trade or not, it all depends on your broker. So that's a question that you should ask your broker before you trade, as to how they handle expirations. If you're in the money, do they automatically exercise you, or do they give you the difference? That's up to you and your broker. Questions: what's the suggested expiration on a debit spread? Weekly, monthly? So there's no suggestion, right? So most people who are trading debit spreads will usually trade 1 to 2 months out, but nothing stops you from trading further or shorter dated. But most people that have a view on if you're expecting a large move one way or another, you usually expect that to happen within a few weeks to a month or so. So that's why most people will trade 1 to 2 month options with a debit spread. Credit spreads, people tend to be a little bit more shorter dated. So credit spreads, usually people will trade about 1 month out, 1.5 months out. That's usually the extent of a credit spread. I have a question here. Can you trade spreads on an IRA? Absolutely. So, it depends on your broker, but most brokers should allow you to trade a spread in your IRA. William's asking, if I get the amount of money, if I close out a spread that still has time before it expires, how can I use your system to give me some idea of how to stay or close or stay a while? So that depends on whether you're trading a debit or a credit spread. So like I said, with the debit spreads, it's really easy to calculate that. You want to cut your losses if you've lost more than 50% of the trade. If you want to take profits, you made 50 to 75% of your trade. On the credit spread side, it's a little bit more complex. You have to figure out how much premium you receive with respect to the width of the spread that you're doing. That's how you decide whether you want to close the trade or stay a while. Keith is asking, does your platform do butterflies and condors in the same way? Absolutely. So you can use our tool. You can click on modify here. You can use a neutral strategy. So if you want to trade butterflies, calendars, condors, all of that is available here with the click of a mouse. So you can set up a put condor. You can move the widths and expirations very quickly, just like that, the click of a mouse. So you can use our tool for all types of strategies. Great question. Carlos is asking, when you're taking a trade, how far out do you normally go on debit versus credit spreads? So I answered this a little bit in the previous question. Debit spreads, most trades are somewhere between 1 to 2 months out. Credit spreads tend to be a little shorter, so a few weeks to about 1 month, a little after a month sometimes. So a lot of times when you're trading the credit spreads, people like to trade the weekly options. On the debit spreads, like I said, anywhere from 1 to 2 weeks, 1 to 2 months out. Daniel's asking, how do you have the CCI showing in the chart section? So Facebook happened to be a trade that was triggered by the CCI. It was a sell signal on the CCI, so it automatically displays it to you. But if you want to put your own indicators on it, you can click on the expand button for the chart, and then there's a studies button which allows you to enter any study that you want. You can use the commodity channel, which is a CCI right here. Vincent's asking, my options play shows Facebook call vertical at 1020 and put vertical at 1890. Why are they different? That's just the difference between the prices of the calls versus the puts. You also can't make a direct comparison necessarily, sometimes because of the fact that the strikes may not be the same distance. So the cost of the trade is dependent on, so the put is, this is a 20-point spread on the put. The call here is a 17.5 point spread on the call. So those two aren't fair comparisons, but that's part of why the difference in the spread, but also the calls and puts can trade at different prices. They don't have to trade at the same price. So that's why you have a difference between the two. Steve's asking, do you plan on holding webinars on your site to trade straddles? I don't have any of those planned yet, because very, very, very few people actually trade straddles. Number one, if you're buying a straddle, it's almost never a winning proposition to buy straddles. And if you're selling straddles, they have unlimited risk on both sides, and very, very few people have the ability to sell naked straddles in their account, nor would I necessarily recommend you to do that. So that's generally speaking why we don't do one. If you have a specific questions about straddles, please, click on the questions, ask us button, send us your questions about straddles. I'm happy to answer any questions you have on that. But I don't think I'll be doing a webinar specifically on straddles. Okay, I got a lot of questions to get through here. I'm trying to get through as many questions as possible. Pamela is asking, I pay attention to volatility and trade credit spreads. When volatility is high, looking for the crush. Do you agree? Absolutely. So like I said, the best conditions to trade credit spreads is when you have a higher volatility environment. So this is when you're expecting a volatility crush. However, this is the one thing that I want to say, and I feel that there have been educators in this market that have oversimplified volatility. Volatility is an extremely, extremely difficult thing to understand. However, people have kind of oversimplified volatility to say, oh, sell volatility when it's high and then buy volatility when it's low. But that doesn't discount the fact that because volatility is high, it doesn't mean that I can't go any higher. So that's why I don't like to oversimplify things in saying sell credit spreads when volatility is high and buy debit spreads when volatility is low, because when it's low, it can continue being low for a very long time. It's been low. Volatility has been very low for a very, very long extended amount of time. So it doesn't necessarily mean that high volatility is a good time to sell credit spreads. However, if you feel that volatility is going to come lower, that is a good time to sell credit spreads. So I want to make that clarification. I have a question here is, do you see the option chains with Greeks? So the reason we built this platform is so that we don't have to look at the option chains with the Greeks. If you're looking for a specific delta, if you're looking for a specific Greek, I still think the option chain is the fastest way to go about finding that. But we specifically designed this tool so that you don't have to necessarily look at the Greeks when you're selecting your strikes, because what we do here on the strike dropdown is we show you where the one standard deviation move is, which is really the only delta that most people are concerned about, is where is that one standard deviation move, because that helps you determine which strikes to sell or which strikes to buy. So that's what we use here on our strike drop down. We stay away from the Greeks a lot of times because just understanding a Greek still requires you to crunch those numbers in your head. We use this P&L calculator so that you don't have to crunch anything. If I told you this call has a 75 delta and you think the stock's going to move up $10, you still have to crunch those numbers in your head. Here, we don't have to do that. You just have to say, I think Facebook's going to go up by $10, and we'll tell you exactly how much this call will return you in profit, so that you don't, because that's really what you're looking for when you're trying to calculate these yields. And that's why we try to stay away from those deltas and Greeks, because we do all the calculations for you. I have a question here is, what's your thoughts on deep in the money, long call or long put? So that really depends on what your views are. Deep in the money, long calls and long puts are good for if you have a long-term bullish or bearish view that you want to take using options. As far as how far out you go and what delta you use depends on how bullish or how bearish you are. And that's a hard question to answer without understanding exactly what your views on the underlying stock is. Where can we get more in-depth training on using your system? Great question. So all the webinars that we do are recorded. So you can go to our YouTube channel, and what we have is a Learn to Trade playlist. So it covers all the topics that we talked about here, including trading earnings, directional edge, generating income, debit versus credit spreads. All of that is available on our YouTube channel. So I think that's the best way to get more in-depth training on our platform. Sorry, there's so many questions here. I'm trying to get to as many as I can. How do you manually calculate risk reward and ROI on spreads? I'm not sure why you would want to calculate them manually, because it's all available to you here. So you know exactly what your reward here and what your max risk is. It's all here. You don't have to calculate anything. If you want to learn how to do them manually, there's plenty of resources online to help you kind of do that. I certainly wouldn't encourage people to do them manually, especially if calculators are ready to do them for you. And your ROI is calculated right here on your P&L simulator. So you just say, I think Facebook's going to go to this certain price, calculate exactly your yield and your performance here. So I'm not sure why you would want to do them manually, to be perfectly honest. Question here, how do you close when the stock price is at max profit level only a few days after trade and long before expiry? So you can do that right here. So you can choose any specific date. So if, let's say, you think this thing's going to make a big move in just a few days, it'll tell you exactly what your expected profit for each strategy is right here on your P&L simulator. Vincent, I can't help but think that maybe you're looking at a different expiration. So this is the June 1st expiration, not the June expirations. I'm pretty sure that our option prices should match up pretty much any other system out there. Michael's asking, is there a cover call strategy in options play? Absolutely. So this is not something we covered here today, but it's part of our YouTube playlist. We have one specifically on generating income. So if you click on the income tab, you can get your cover call idea and a short put idea, all available to you, very similar to the trading tab, but specifically geared for those of you that like to sell cover calls or short puts for income. Sam's asking, what strategy you advise around earnings announcements? So we have a specific strategy, a specific webinar on trading earnings like a pro. I highly recommend you to watch that if you want to learn how to trade around earnings. I have a question here about synthetic leaps. I want to try to keep the questions to the topics that I'm talking about here today. So if you have a question about synthetic leaps, please click on the questions ask us button. I'm happy to answer all your questions there. Jeff is asking, how does our system choose the appropriate date and strike? So the dates, we always look out 45 days as your starting point because, again, most people like to trade options that are anywhere from 1 to 2 months from expiration. That's why by default we'll look out 45 days. And the strike prices, when we're buying, we're always looking at roughly the at-the-money strikes. When we're selling, we're always selling roughly the 1 standard deviation move. So that's how we go about selecting the 167.5 because that's very close to the current price of 168. And we're selling the 185s because that's roughly the 1 standard deviation move. So that's how we select our strikes for the debit spread. Pamela's asking, I've been closing trades over earnings because I've had a couple of big losses. What do you think? So that's completely up to you as to whether or not you feel comfortable holding a trade into earnings. We had this trade, Philip Morris. This was a trade that was not working really well in our favor, but one of the things that really kept us in the trade is because the relative strength was really weak. We like to hold shorts when the stock is very weak, especially if it's in a weak sector and earnings are coming out. So we usually look at relative strength as an indicator to help us determine should we hold the trade going into earnings. If you're bearish, you want to see a weak score. If you're bullish, you want to see a strong score because weak stocks tend to miss on earnings, strong stocks tend to beat on earnings. So this is really the one reliable indicator we use to help us determine whether or not we want to stay in a trade through earnings. As you can see, this allowed us to stay in this Philip Morris trade, which is now up about 230% on this particular trade. Jason's asking, what technical indicator are you showing below Facebook? Like I said, it's CCI. So as you can see, it's overbought on the CCI indicator here. It's the CCI indicator here that gives you the red or green. Kyle's asking, why are almost all the spreads in the recommendation wide ones? I'm not sure what you mean by wide ones. Maybe wide based on what you're used to trading, but when we usually, like I said, we choose our strikes based on probabilities. So we will usually buy in at the money strike, and we will sell a 1 standard deviation away, because that is usually a good price to consider selling. You want to sell an option that has relatively low probability of hitting. How can I get buy and sell signals? So that's really kind of what our bullish and bearish trade ideas are designed for. They give you signals specifically to look at buy and sell signals. So for example, here, I'm just picking a random one. What it does is it gives you these buy or sell signals. It gives you that green arrow to tell you we've got a buy signal. And these are all based on the technical indicators that give you the buy or sell signal here. So you can use our our trade ideas. You can scan for bullish and bearish ideas every single day and see which stocks have triggered a buy or sell signal using technical indicators. How does your platform show volatility for each stock? So we show it right here at the bottom. As you can see, the volatility will show you the current volatility. One of the things that we don't do is show you volatility comparison to history, because we find that overgeneralization is what leads people to sell options just because it's high and buy options just because it's low. But high vol options doesn't necessarily mean that it can't continue going higher, and low volatility doesn't mean that it can't continue going lower. So that's why we use the options play score. The options play score gives you an idea as far as whether you're when you're buying, whether it's cheap or expensive. If you're selling, whether it's cheap or expensive. It already does all those calculations for you. So as you can see here, when I'm buying this call and I get a score of 78, what that tells me is that this option is quite expensive, or volatility is quite high. Conversely, if I was to sell this, as you can see, I get a higher options play score because this option is quite expensive. I get a much better options play score when I'm selling it versus when I'm buying it. So that's really how we go about looking at volatility. You don't have to figure that out. It does all that calculation for you through the options play score. So I have a question here about any indicators from Thinkorswim can move to your platform. Unfortunately, no. We have no relationships whatsoever to Thinkorswim. But you can always use your Thinkorswim platform to generate your indicators, to generate your signals, and then come into options play. So for example, if you get a signal on, I don't know, Tesla today, and it tells you to go short Tesla, then you would come in here, you can click on I'm bearish, see the strategies, and you can set up, a credit spread if you'd like instantly just by setting this up very quickly. So that's how I would use them. What is the bar above the CCI? I think people are referring to this green and red bar. So this tells you the current 1 month and 6 month trend. So the 1 month and 6 month trend tells you the current value, but we also show you historically how that has changed over time. So that's what these red and green bars is. This shows you how that 1 month and 6 month trend has changed over time. I'm trying to get to as many questions as possible. There's simply just too many here to finish all of them today. So what I'm going to do, like I said, is I will send out the recording with the emails for this webinar in about an hour. I really hope that all of you guys have found what I talked about here useful. I know I didn't get to all your questions here today, so please, if you have any additional questions, please click on the questions ask us button. That's the quickest way to get to our support team. We can answer as many questions as possible there. So please log on to Options Play. Take a look at what I've shown you guys here today, the difference between credit versus debit spreads. I hope you guys have found this useful, and we'll send out the recording with the slides so you'll get everything. The Q&A is as part of the recording. So any more questions, I really want to get to all of them, but I simply just don't have enough time here to get to all of them here today. So please send us your questions, and I really hope that you guys have found this useful. And we're going to be back next week doing another webinar next Thursday. So I hope to see you guys there next Thursday as well. So thank you guys for joining me this afternoon. I hope you guys have found this useful, and I look forward to seeing everyone next week. Have a good afternoon.